Our MarketsWiki Questions Exploring Financial Technology interactive video series examined the intersection of technology and the financial markets by posing 7 critical questions to dozens of market and technology experts. For our culminating event in Chicago, we've invited 7 of these experts to further investigate these questions.
To define risk management and talk about the question that was posed, which is which of the 3 different general categories of businesses, exchanges, brokers, and firms, are responsible for risk management, and what's the best way of tackling it. First, we have to define what we're going to talk about in terms of risk management. So I'm going to go ahead and disagree with Nick and talk about a transaction chain that is from the beginning of an order generation to an execution. So over here on this side, what we're going to have is the actual firm, non-member, and there where the order generation happens and the idea generation happens. So this has an area of risk management, and this for type of risk management is really more around the lines of how much capital am I committing to this particular type of trade and what type of trade it's going to be. So let's make up a trade. Let's say it's going long silver ETFs when the moon is full. We'll call it the werewolf trade. As an aside, through this journey of career so far, I have actually run across people building up models on astrology and astronomy, so we'll use this as a little go-to to them. So we're going to go long, and when the moon is full, we have a signal. That signal now generates time to trigger an order. That has some sort of system built around it for risk management of that position. We're not going to talk about that anymore. The order goes over to a broker. The broker now has a duty to take that order and transmit it somewhere. The broker has a large level of risk management, and in fact, the way I've interpreted this question for today is around the SEC's rule filing 15C35, the market access rule. We're going to come back to that one. So the order comes over to the exchange, and the exchange receives the order, and now there's another level of risk management that happens. And this is back to the earlier discussion. Exchanges have, especially the lit exchanges, have rules going back to the SEC 1934 Act to enforce fair and orderly markets. So the risk management systems that are employed at an exchange are very much around that, making sure that an order came in, it hits the book, is prioritized the book in a correct and ordered manner, that's been transmitted to the market in terms of rules. We're not going to talk about those anymore either. After the order is completed and is going back through clearing, it's going to come back to the original firm that set the order off, and starts the whole circle over again. So let's talk about what happens in terms of risk management for the broker-dealer. And I'm using this for more along the lines of just market access. So the order comes in, and specifically what the commission clarified for firms in the industry is that now over each one of the orders that are presented to a market in your name, you have to kind of know what's going on with that trade. You have to have exclusive and unique control over the systems that those trades are coming through. So those unique and exclusive controls break down into 2 different main categories: financial controls and regulatory controls. So when we're talking about risk management and whose responsibility it is, what we're talking about for the broker-dealer is the responsibility to manage what's happening for the flow that's coming through their systems for any of the underlying systems. And so if you want to go into each of those 2 different buckets, for right now, we're underneath the new regime, so the rule is effective, and it controls for things that we were talking about earlier: fat finger blocks, too large of orders, too many orders. So you'll see systems that have blocks that are set to protect against the algos that are out of control and sending too many orders, which new information shows that that's what the flash crash actually was. It wasn't just it might not just be that small Midwestern broker sending a lot of future orders. They're going through an algo of a larger firm. So risk management, if it had been placed in terms of very simply looking at it, is in terms of the number of orders a second sent out, that would have controlled and connected against, protected against those particular issues. So I wanted to come back then and say that the hardest part right now with the industry, and what you see a lot of conversations and public comments about, are if I'm, as the broker-dealer, responsible for everything that's coming through me for this guy, the werewolf trader, and he is, as mentioned earlier, he might be executing through multiple places. I'm supposed to, as the broker-dealer, block those orders based on overall credit. But he has got credit in multiple places. So that's where, as going back to the regulation aspect of risk management, that's where the industry together has to come together for a centralized point to pull in for the credit limits. So the second part of the question was, how does technology play, and how is the best way to tackle the risk management for both, for each one of these areas, the firm, broker-dealer, and the exchange. Now is a great time to mention the fact that I'm responsible for building up outsourced risk management systems, and so I firmly believe most people should buy them, not build them. But with that said, it goes back to where is a particular firm actually adding value. So if you have the development dollars, if you have the resources, what are you doing? I can tell you for a werewolf trade guy, he's probably building that. He's building some sort of system that says, I know my position in the morning. I know what the phase of the moon is. And I believe that this is what silver is going to be worth. So it's tough to say that there's going to be very much outsourced in that area, although there are front-end vendors that want to compete in that area. When you start talking about broker-dealers, now broker-dealers is a small word that captures a whole lot of different business models. And so there's absolutely proprietary traders that fall into this area, as well as the firms. There's agency brokers, and I can go on. The point here is that some firms actually do compete on their level of risk management. So they're able to offer better margin because they've been able to capture the information. They're able to offer better commission rates, tiers, because they have more flow because they have the risk management levels. And finally, some offer fully outsourced systems for the firms that want to be able to build up their own stuff, but then have that one last regulatory check in play. So who can do it best there? There's a lot of play. And you'll see firms either working with or buying software from to do that. The exchanges and the ETSs and the dark pools, very different story. So so a big chunk of the exchange, of this group of where the order actually gets managed, are building it themselves. And there is a growing push to see if there's some sort of way of standardizing the risk management capabilities. Really, the risk management capabilities on the exchange side boils down to more about surveillance and compliance. And so you'll see a couple of those firms doing there. Walking back to the idea of information being dropped on the floor, large post-trade pattern matching systems are being built for risk management.